Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and compelling investment opportunities. Discover what's next at ausbizcapital.com.au. This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Good morning and welcome to the Global View on this Monday here at Ausbiz. Thanks for joining us. I'm Andrew Gagan. Let's get into it then and see how we finished on Friday. Global stocks mostly down, but they did make the biggest monthly gain since late 2023, with sentiment buoyed last week by signs of easing trade tensions. Wall Street's main indices were choppy and did finish mixed as US President Donald Trump accused China of violating a tariff agreement. Now for the month, the Dow was up close to 4%, the S&P 500 up more than 6%, its biggest monthly rise since November 2023. And the Nasdaq rallied more than 9.5%, was also its biggest monthly gain in more than 18 months. Checking in on those Mag 7 stocks, Nvidia coming off close to 3% on Friday. Tesla eased from a 16-week high as Elon Musk stepped away from the Trump administration. The stock was up 2% on the week. On the earnings front, shares of Ulta Beauty jumped after the cosmetic retailer raised its annual profit forecast after beating quarterlies. On the flip side, Best Buy fell after cutting annual forecasts on tariff uncertainty. And US listed shares of Rio and Tinto both falling as the copper price fell. Well, over the weekend, President Trump revealed plans to double tariffs on imported steel and aluminium to 50%, increasing pressure on global steel producers. Australia exported more than $414 million worth of iron and steel and $418 million worth of aluminium to the US last year, which was about 10% of their output. Trade Minister Don Farrell calling the move unjustified and not the act of a friend. Well, the latest salvo in Trump's global trade war came just hours after he accused China of violating an agreement with the US to mutually roll back tariffs and trade restrictions for critical minerals. Subsequently, US Treasury Secretary Scott Bessent said President Trump and Chinese President Xi Jinping will speak soon to discuss trade and, in particular, that dispute over critical minerals. Well, in data, US consumer spending increased marginally in April, the Personal Consumption Expenditures Price Index edging up 0.1% on the month. US Treasury yields slipped as risk sentiment worsened on concerns of a potential escalation in the trade war. The yield on the 10-year fell to a two-week low to around 4.41%. The two-year was down to 3.9%, but up 29 basis points for the month. And the US dollar was mixed on Friday, but on track for its first monthly gain against the Japanese yen. The Aussie trading at 64.5 US cents. And Bitcoin is trading just under 106,000 US dollars. US crude futures fell as OPEC Plus was deciding to boost oil output for July beyond previous forecasts. Brent crude futures down close to 0.5% at $63 a barrel. Copper prices were little changed. Iron ore down slightly at $96 a tonne. And gold prices slipped on Friday as the US dollar edged higher, but more recently has recovered to be up around 0.5% at $3,305 an ounce. All right, let's get across what is moving markets globally at the moment. Isaac Poole joining us from Ascalon Capital. Isaac, welcome back. Good to see you. Let's start, obviously, with the latest trade issues with Donald Trump, and in particular his accusations against China. And then on top of that, of course, he slapped now 50% tariffs on steel and aluminium. How's this playing out?
Well, it shows that these tariff concerns are not over yet. And I think that markets really had got ahead of themselves with this belief that the tariff issue is done now, and that there's a lot of bluster and noise coming from the US President Trump. But when it comes down to it, nothing will be implemented. I don't think that's the right position to take. I think we will see tariffs implemented in a meaningful way over the next 6 to 12 months. And this latest round of news coming out of the US over the weekend suggests that it could be meaningfully higher than what people have put in as a base case, and that does introduce some risks to the global economic outlook.
Yeah, so I guess, and you point out the critical date is that the end of that 3-month period, which is July 9th, and as you term, many people now calling that Liberation Day 2.0.
Exactly. It is looming large. It's not that far away. And there are a lot of countries that would need to agree some sort of a deal between now and then to get through all of the countries that have had tariffs announced on them. And that doesn't seem very likely. Of course, Europe is an important country. China is an important country. But there are other countries out there that will be equally or as almost as important. We do have this one day that seems to be a real center point for focus. And as we get closer and closer to that, I think the volatility that we've seen at the back end of last week, the volatility we saw through May on the upside and in April on the downside, all of this could come to a bit of a head. And that goal or hope that equities just keep climbing higher over the course of 2025 could come under a lot of challenge as we approach that date.
So let's look at the effects of what's going on then, Isaac, with those elevated tariffs obviously remaining in place and the effect that has particularly on consumer goods. Then when you take a look at the states, how much of a drag is that likely to be on earnings growth, do you think?
I think this is a really important point because we do take the view that tariffs will reduce growth and tariffs will increase prices. And some of those prices will be internalized by companies, and some of that price increase will be passed on to consumers who are already facing the impact of cumulative price gains. And that will, we think, slow consumer spending. And a really critical part is the jobs market. If we see any cracks in jobs, consumers will spend even less. And this is why it's important. The spending from consumers drives sales growth and earnings growth in a world where margins are likely to be a little bit under the pinch or a little bit compressed from having to internalize those price increases. It's difficult to see a material reacceleration in earnings growth in the US over the course of this year, and that is exactly what the current level of PE valuations are pricing in. And we think that is not exactly a heroic assumption, but it's very hopeful at this point.
Isaac, we do get key jobs data out of the States this week. Overall, what do you see as the risks of recession in the States?
I think that a recession is a possibility. It's not really a base case at the moment, but it could happen. The way that this could materialize is that jobs growth slows, the unemployment rate picks up, and a negative feedback loop kicks in as consumers spend less and businesses invest less. And overall, that reflects a bit of a turning point towards slower growth, and it feeds on itself. Again, not our base case, but those first cracks in the labour market is why this Friday is such an important data point. It really does drive the future for the US economy over the next few months. We think that while you don't get a recession, it's unlikely that growth reaccelerates materially over the back end of this year. So if we had 2.5% to 3% growth or so over 2024, perhaps we only end up with 1.5%, maybe a little less this year, and that's a difficult backdrop for earnings growth to reaccelerate.
So it's going to be interesting. We do hear from Jerome Powell this week to see what he has to say. This, of course, comes after Donald Trump essentially lent on him again last week to cut rates. Also, we got the Bank of Canada and the ECB meeting. What was the prospect of cuts from those central banks?
I think that there's a good chance we see a rate cut in the ECB. They have had both sides of the coin here, with some of the members saying maybe we just pause, others really pushing for a rate cut. I think they will favour a rate cut, try and get ahead of the curve. They do see growth really having a risk to the downside if tariffs are implemented and if sentiment remains sour. And this is going to be a big difference to the US Fed, who resisting calls for a rate cut from the Fed president, and rightly so at the moment, because the economic data are quite resilient. There's not a smoking gun, if you like, to cut rates from here, especially after all the rate cuts we saw at the back end of last year and start of this year. So that divergence in monetary policy is a bit of a risk to the global economy, and I think it could be something of a risk for the US economy if the Fed does hold rates where they are for too long.
So overall, Isaac, what's your portfolio strategy at the moment?
We still quite like US Treasuries with yields up around 4.5% or so. Now we've liked them from about 5% or a touch above where they were at the back end of last year. We thought that was very attractive. As they've grinded lower, they've become maybe a little less attractive than they were, but 4.5% or so gives you pretty good income, pretty good yield, really good downside protection, and you're not really driving or hoping that there'll be a reacceleration in the economy to drive your gains here. So equities looking a little less attractive. Treasuries still looking like they're offering some good outcomes for investors.
And equity-wise, are you less partial to exposure in the States, perhaps looking elsewhere?
I think the really important part for investors in global equities at the moment is to get diversification. And at the back end of last year and start of this year, everyone was piled into the US in a really big way. It turns out that wasn't the right place to be in such a big concentrated way. You do need at this point in the cycle, we think, to really get diversification. So that includes some Europe, it includes the US, it includes Asia, but also styles. So get some quality value in the portfolio. You can get that through listed infrastructure. You can get it in other ways, but don't just pile into growth. Don't just pile into US-led growth at this point in the cycle, because it just brings a lot of risk to your portfolio.
What's your view on Chinese equities at the moment?
They're offering good relative value, but they have done that for a little while. We think that they can be an important diversifier and an important upside potential return, but we'd say that's really only for investors with quite a significant risk appetite at the moment. It's not something that is going to be for everybody.
Isaac, always great to get your global view. Thanks for joining us from Ascalon.
Thanks, Andrew.
So let's take a look at where we're likely to get going locally then. SPI futures indicating a mildly positive start to begin the week, and we're going to get right across that in just a couple of minutes' time.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.